Welcome to this exclusive interview with Jeff Tesch, CEO of RCN Capital. This is an explosive conversation about how to find the right capital partners and secure financing you need to grow your real estate investment experience and your portfolio. Jeff also shares his optimism on the future of real estate investing and offers valuable advice for new and seasoned investors looking to grow the market successfully. Hey, it's V. Lee, and you are watching the Real Estate Ballers Show. If you enjoy our videos and found value in this channel, can you please do me a quick favor and hit that subscribe button? It helps this channel more than you know, and we really need it. We really need your help to get the word out. So thanks and enjoy this video. I'm sorry for this interruption. I've been asked a lot about passive investment, and I understand that there is nothing passive about being a landlord unless you can find a great property management company. So if you own an Airbnb, a vacation rental, or a short-term rental, and you are looking to free up your time, contact our team at Buzz Vacation Rentals at 281-549-8432, or check out our website at www.buzzvacationrentals.com. Thank you, and back to the Real Estate Baller Show. This episode is brought to you by Jet Lending. For over 20 years, Jet Lending has been helping real estate investors succeed. They offer 100% financing so you can be in at $0 at closing. I can always count on Jet Lending to fund my deals. If you're looking to fund your next deal, contact our friend over at jetlending.com. This episode is brought to you by National Real Estate Insurance Group, a national independent insurance agency specifically for real estate investors. I personally use NREIG for my investment properties. They offer a low monthly payment option to help you to lower your cash out of pocket when buying an investment property. If you're looking for insurance coverage for your flips or your rental, reach out to them. You can click on the link in the show descriptions, or you can reach out to Jules at 816-946-8443. All right, we finally got Mr. Jeffrey Tesch in the house. And I'll tell you what, it's only took me about 4 years, I think, to get Jeff on today. So this episode is gonna blow you away. No doubt about it. Right, Jeff?
V, you are persistent. I will give you an A++ for effort. But hey, we finally made it happen. I'm so excited.
That's right. So I was just preparing for this show, and I didn't realize that, Jeff, you are big time. Like, you know, I was reading and I was almost fell out of my chair that you were actually overseeing $6 billion in originations. Where did you even get that kind of money, Jeff?
Like all things, you usually start small, right? So yeah,
start with a couple of million.
That's right. Yes, true story. We have originated over $6 billion. We started RCN Capital back in 2010, really as a play on the foreclosure crisis. The idea was we were going to take our own equity, myself and my founding partner, and we were going to deploy money into what was a mess, right? 2010, foreclosures everywhere, short sales everywhere. What we saw in the marketplace was a very disenfranchised, sort of very scattered approach to private lending. And what we thought was there's probably an opportunity here to build out a company that perfects hard money lending. And that's how it started. And we've been at it ever since.
Well, congratulations. You guys are doing an awesome job. So, and I'm proud to have you on today.
Thanks so much, B.
So would you say most of your customers today are the fix and flip?
The past almost 15 years, we added other products, the biggest one of which is rental financing. So what ended up happening over the years is, as the housing market improved, as demographics changed, as investors' appetite for risk changed, many folks decided, instead of just selling houses and making a short-term game, we could build generational wealth and hold on to these houses and rent them out for families to live in. Many families today like that idea of the ability to be able to rent so they can be more transformative in their lives, moving from place to place with much greater ease. Many investors have taken advantage of that. And we now provide it's over half of what we do today is providing financing to investors who are holding these homes for rental income. And many times what they do is they buy these really beat up houses, they make them livable again, and then they rent them out to families and then go on to the next and the next.
I'm pretty sure there's different criteria in your short-term fix and flip loan versus your long-term buy and hold loans.
That's right. Yeah. The short-term sort of fix and flip, right? We're really interested in what that asset is being bought for, what that asset is going to have improved, and then eventually what the sale price is. Like all real estate, right? Real estate is local. We want to make sure that our customer is not over improving the house so they won't get a return on investment. We want to make sure they're not the most expensive house on the street, right? You want to be middle of the road where you are typical for that neighborhood. So when we own these short-term fix and flip loans, it's all about the asset. Yes, we look at the guarantor. We typically check their track record and make sure they have had some sort of experience in the fix and flip world, making sure they know what they're doing. But at the end of the day, what we really want to know is, are they going to make money when they go to sell this house back into the marketplace? And that's the biggest part of underwriting a short-term fix and flip loan. On the other side, on the rental side, it's all about how an investor has treated their portfolio of loans over time. And what I mean by that is, are they a good steward of capital in the long term? That means we want to see a background check. We want to see their credit score. We want to understand that over the years, as they have acquired rental assets, they have paid these assets back on time. And that as they build out that generational wealth, they truly are taking good care of long-term assets. A very different product from that buy, fix, and sell.
So could an investor buy a property with a short-term and convert it to a long-term?
Yeah, so that's pretty common these days, where folks are buying an asset, making some money, right, fixing it up. They're investing sweat equity often. They're making money by building up the asset value. And then it's, instead of cashing out, they're going to come back to us and they're going to say, you know what? We would like to put a renter in here today. So it is truly two separate transactions, but they often marry right at the end. And then we'll go ahead and underwrite what that rent's going to be. And then as long as the rent pencils out for what the debt service is going to be, boom, we close it, away they go, they're rented out, and move on to the next.
What were some of the advantages of working with someone like us versus a local harmony lender?
Well, especially on the more institutional side, meaning folks that are looking to really make this their living, right? Whether it be buy, fix, and sell or building out rental portfolios. Those folks that are just going to really be in the investment world for the long term, it's great to have a partner that has a track record. There's lots of short-term lenders around the country. There's lots of localized lenders that do what we do. But we take a great deal of pride in having those relationships over the long term. And it kind of goes back to what I said earlier, which is we wanted to build out a professional short-term and long-term solution for investors that they could rely on. Many smaller lenders are capital constrained. They don't have the ability to be able to scale along with their customers. We believe that the platform that we have built, while being really hands-on, being very human resource intensive, meaning you have somebody on our side that you know and trust. It's not just a call center somewhere. We believe that over the long term, we're going to be the better solution because, number one, the capital that we can provide, but more, the most important thing, is the relationship that you're going to have with us to help you build your platform over time. There's nothing more important than that human connection that we foster and help the customer grow.
Let's touch on that long-term loan for the buy and hold investor for a minute, and then we can steer the ship a different direction. So correct me if I'm wrong. I'm a big believer or a big proponent of community banks because they used to have low interest rate. The downside of that is it's 5 years, typically adjustable balloon note, and you have to renew the loan. But working with RCN, it's more like a 30-year fixed program. You know, you pay a little bit higher interest rate, but like in the last few years, what we experienced, you know, your rates won't go from 5 to 9, let's say. So is that fair just to make that assumption, a statement?
Yeah, there's two things on the community bank side. Number one, especially for newer investors that have relationships with community banks, it really is a great place for you to get your feet wet, especially if you know your local banker. Not all community banks have an appetite for business purpose lending, right? Remember, the loan that investors take out is not the traditional loan that somebody who's buying a house is going to get. And you got to make sure that your local bank has an appetite for that. But it's often a good place to start because you have that relationship. But oftentimes investors graduate from that loan quite quickly for two reasons. One, you touched on, which is it's not typically a 30-year loan. The debt service coverage ratio, which is a fancy word for long-term rental financing, that loan is geared to be a long-term loan. It's 30 years, it's a fixed payment, you know what your payment is, and we're locking in an interest rate today. There's usually some component of usually 1, 2, 3 years, but after that, you have the ability to be able to refinance if rates should go down. The importance of that is as time goes on, typically rents rise and you will capture that income and you know what your fixed cost of financing is. There's not going to be a balloon payment in 3, 4, 5 years, as you mentioned, That's one side of it. And then the other side of it is for investors that are really going to be making a business out of what they do in the investment world. Most small regional banks, local banks, credit unions, they're going to cap you out at a certain number of properties, whether it be 5, 10, 50. There's going to come a point for most banks where they're going to cap you out. And that's not the way we look at things. We look at as being that partner that's going to help you grow however big you want to grow. And that's really an important part as you're building those relationships.
Yeah, I think they either cap you out or want you to have a certain amount of reserve deposit in the bank. And you know, so one way or another.
One way or another.
All right, so let's shift gears to your RC business. So you've done a wonderful job at raising some money. You know, you touched on it earlier, a local harmony lender. I think that's one of their probably a challenge in their success is they can't loan out more than what they have. So what are the key factors that, you know, help you to your success in securing the capital so that you make sure you don't ever run out of money to loan out?
Yeah, and you know, we started like every local lender back in the day. Now, we had more equity to work with than most lenders because of the nature of our ownership. But the reality is we were capital constrained the way every single lender was back in the day. And even today, as small lenders get started, sooner or later, you just run out of money. And the way we started was certainly like that. And then eventually, what we really worked on was the ability to be able to warehouse loans with regional banks. And what basically that means is they give us lines of credit where we participate in that loan with our money, and then they fund a portion of it. And that helps us exponentially grow. And then as time goes on, especially in the short-term stuff, we build out that portfolio, and then it pays off anywhere, usually 6 to 12 months, and it becomes like a revolver. And we make sure that that warehouse capacity, that ability to fund internally, never gets to the max, right? How do you get there? Well, it's mostly track record. Track record is what's going to get you there. Certified financial, audited financials. All these things help different warehouse providers give you that certainty that you're going to be a good steward. And then, of course, on the other side of that is equity. You have to have participation equity to go along with whatever sense of financing. And that equity is oftentimes why smaller lenders run out of money, V. It's because they just run out of equity. And even if they have some secondary form of financing, they're out. And once you're out, it doesn't make a difference whether or not you have that line or not. It's something that we've really focused on to reinvest in the business and make sure that we have that sense of capital. Now, the other side of things, very, very different, is the rental loans. Now, the rental loan, we're writing 30-year loans. We have no interest in holding 30-year loans on our books. But what we do is we close them with our own money, we hold them, and then we package them together, and different entities will take them off our hands for the long term. Could be insurance, could be hedge funds, could be large capital institutions, that names you would recognize out of New York. All of these sort of longer term debt solutions are looking for locked in long-term rates. And that's where the 30-year stuff comes in. And once again, it's track record. How is RC formed? How is a lender? Are we doing good underwriting? Are the loans that we've written 1, 2, 3 years ago on the long-term side, are they performing? That track record goes a long way in being able to find those capital partners. They're going to help you build out a rental portfolio.
You took that word out of my mouth. I was going to ask you, usually are they performing notes or non-performing notes?
That's right. You know, as a lender, we have to always look at every single dollar, whether it be our money, the warehouse money, the insurance, wherever our loan is going to end up, we have to write every single loan as if we're writing a check out of our bank account, right? Like as if it's our own money, because that track record, to your point, V, track record is everything. We want every loan to perform for the life of that loan.
Do you see that people actually hold their note for 30 years, or what's the average on that?
Well, what's interesting is most of the loans that we've written on the rental side over the past 5 to 7 years, there was a big refinancing boom after COVID.
Yeah.
So a lot of that paper, 22, that we wrote before that got refinanced. Rates went down, right?
Right.
Even if there was a prepayment penalty, because the rates went so low, it was worth it. And as rates have come back up, all those loans are basically staying where they are. But to really get to the crux of it is, it's an interest rate driven equation. It's a math equation. If rental rates go below a certain level, is it worth for me to refinance? And then they'll refinance. If it's not, then they hold them. And then, of course, if they just choose to sell, then that's a different, conversation. They sell the investment property, pay the loan off, and move on to what's next.
So you're saying that more than half of your business is the long-term loans. And is that the case in today's market with the interest rate being the way it is? And, can people still hold rentals?
No, it's a good question. And it's something that we were definitely worried about when the interest rate cycle began to turn, right? Like we were worried about it. Like we were afraid that interest rates were going to go up, but we really weren't worried on the bridge side. We were worried on the rental side, right? That the interest rates were going to get so high that we weren't going to have the ability to be able to service what the debt would present itself, because the regular rents wouldn't keep up.
Yeah, because you have interest rate and also taxes and insurance. They all went up at the same time.
All going up at the same time. And what has been surprising, mainly because of the incredible housing shortage that we still have today, is rents truly have kept up not in all geographies, but in most geographies, the rents have kept up with the ability of these loans to pencil out. How long that lasts, we don't know. One of the concerns big one, especially in Texas, is insurance. It's bad enough interest rates have gone from, 3.5 to 7. Insurance doubling over the past 12 to 18 months is providing a really big challenge in states like Florida, Texas, and California. It's a problem.
It is. And we need you to solve that problem for us.
Well, unfortunately, I do not control the weather. I wish I did. Especially in Texas. You've seen these hailstorms, right? Like where entire sections of communities are having every single roof replaced because of a hailstorm. It's not made up. It's real. And the insurance companies are having to foot the bill for this, and they're passing along the costs. It's unfortunate, but it's the reality of today.
Well, I think if anyone was going to go open an insurance company, it would be a good integration, vertically integrated, like a good opportunity for someone like you, like us, right? Wouldn't it be?
Yeah, without a doubt. It's something we actually have thought of, especially on the front end side. What concerns us is the amount of risk that these insurance companies are opening themselves up to today with unknown weather events. And we saw it in Florida this fall. We saw it over the summer in Texas with these hailstorms, California wildfires, flooding in places where we don't typically see flooding, North Carolina, where we have an office. It's a real problem.
Well, like I said, we're going to have to rely on people with, like a brain like you to figure that problem out for a little investor like us. So besides insurance, what other big opportunities that you see in this space that, given the dynamics and given your access to information and data, what other opportunities are you seeing out there?
Well, we're seeing a lot of ground up construction today, more than ever. Once again, because of the large rise in the interest rate coupon over the past 3 years. The well-documented housing shortage has only been made worse because so many folks are unwilling to, and why would they, give up the interest rate that they locked in 21, 22, right? Mm-hmm. If you have a 3.5 or a 4% interest rate coupon, why would you give that up to go buy a different house and now you're in the high 6s or 7? That has locked in a tremendous amount of the inventory that should be on the market because people typically move. That's how America works. People have other opportunities. And today people are only moving if they absolutely have to. There's no any sort of move just to move up because they will not give up that rate. So with that said, investors are in a bind. They don't have the inventory to buy. So they're turning to ground up construction. And ground up construction is an area that we have seen, especially in 2024, we've seen it grow exponentially. And it's something investors never thought, especially smaller mom and pop investors, and something they never thought they would do, but they're being forced to, because if they want to continue to build out these rental portfolios or even short term, they've got to change their strategy. Construction comes with its own challenges, especially last year with a great deal of fluctuation in costs to build those homes. That has stabilized this year, made it a much more predictive marketplace, and folks are doing a much better job. Entitled land is at a premium today, but investors who have a lock in on it, they're doing pretty good, V. They really are.
For someone who, let's say, transitioned from the fix and flip or, even just the buy and hold gal, and say, I want to go now build ground up, where would they go look for source of capital? Would it be someone like RCN?
Yeah, that's right. So it's something that we got serious about really coming out of COVID back in 21. We really put a lot of time and effort in building out our ground up construction programs. And the interesting thing is ground up construction, the loans aren't all that different from a heavy rehab loan. You're basically having a piece of entitled land. You're getting a pro forma on what that particular piece of property is going to cost to go vertical. And then you just do draws in a much more segmented fashion than you would in a fix and flip, where they're usually much shorter and much more bespoke. In a vertical situation, when you're building on a piece of entitled land, it takes a little bit longer. But if you have the right contractors behind you, RCN is all in. We love it.
Are you looking more for like a one property build or subdivision development type?
Yeah, we love infill properties. So no matter whoever's listening to this podcast today, wherever you live, you drive through subdivisions in anywhere America, you will find lots that are just empty on streets that have been built for 5, 10, 15, 20 years. And those are what's known in the industry as infill lots, where somebody will buy that lot and build a house on a street that already has existing houses. The risk is really minimal to the investor because you know what that marketplace is going to trade for, and you know the style of home that's going to sell on that street because they're already there. We love those. Now, we do finance in more new construction subdivision areas, but typically it's going to be on a smaller scale. We're not the lender to go finance 100 home developments. That's not what we do. It's more working with seasoned and professional investors, 1, 2, 3, 4 houses at a time.
Okay, this sounds like the dumb questions, but when an investor try to build a new house in an established subdivision, how would they have issue with appraisal? Because there isn't a like property. So would that then make the value less than what it's actually should be?
No, it's actually a great question, and it goes to how investors should be thinking about new construction, which is if you're going to build in an infill lot in an established area, you really need to think about the square footage, the style, and most importantly, the finishes that are in that neighborhood. And you want to try and mimic them. Now, I'm not saying you want to mimic the 20-year-old finishes inside the house next door. You want to have modern finishes. But if the other homes that have renovated kitchens in that subdivision all used more like basic granite, not super high-end Italian marbles, you want to stick with what's there. And then you will not have a problem getting an appraised value in that community as long as you stick to the values that are in that marketplace. It's really important, V.
Because, sometimes I feel like to price out new constructions, price per square foot, end up being less than, let me rephrase this, by the time you add the lot and the build out and you sell it, and the price per square foot on your new construction can be less than a lot higher than what's sold there. So therefore, you seem like you have to put in a lot more money, and it seemed a bit riskier.
That risk can be mitigated by making sure that, number one, you keep your square footages in line, and number two, any premium that you're looking to get for those finishes is on par with that community. If you go too far over, you will never get your money back.
So let's do a walk down the history path here. When COVID first happened, I know a lot of lenders just froze, like they stopped writing new loans. Did RCN write new loans at the time, or did you guys stop at the time?
Yeah, it's a great question. And one at the time was, oh my God, it was so scary. It was so scary because, we have all these employees and we have a responsibility to them that we take very seriously. And we're like, okay, if we don't have the ability to fund loans, which we paused all lending for about 3 months, what are we going to do? Well, what we did was we worked on process and procedure, and we basically lived off the existing loans that we had and waited for the market to settle down. When that market settled down going into the summer, we began re-lending again. Fortunately, we didn't have to lay anybody off, which was a big relief, because at the end of the day, what we've built was really hard to build, and the value of our team members is everything. And we felt very fortunate. We just felt so fortunate that we were able to get back at it relatively quickly. And then, by the fall, it was like amazing. A lot of you being driven by the rise in housing values, that investors were back in the game so quickly.
Yes, yes. Who would have thought, right? It's nothing like we ever seen before.
Yeah, I'll be fine never seeing that again. I'll be fine if there's no more pandemics.
You and me both. Yeah, that social distancing was tough.
Yeah, I mean, it was so difficult, especially for some of our contractors working with our investors, right? Like the investors were like, let's go. But the contractors were having to deal with different rules and regulations depending on what geography they were in. And it really slowed things down, right? Well, what doesn't stop? Taxes, insurance, any sort of mortgage, all that keeps going no matter how fast or slow you're going on the project. It was a real difficult time for investors.
So we all hope that will not happen again. But can you maybe foresee at what event would trigger, unless, the world fall down, but what would trigger something like that for RCN to say, okay, we're not doing new loans today?
Yeah, it's interesting. You look at the macro environment that we're in today and the well documented shortages of housing virtually in every single geography across our land. It's hard to see how that demand is going to be squashed, right? You got a couple things going on here. You have migration into the United States that has increased the demand for the pool housing that's already existing. In addition, you have a cohort of the United States population that is maxing out between the age of 29 and I believe it's 38, which are the prime home buying years for individuals. We have the largest cohort in, I think, the last 100 years of individuals in that age group. That's also putting it more demand on the existing housing stock. And then you throw on top of that what we discussed earlier, which is the the long-term interest rates with those low rates that's locking in the existing inventory. And you say to yourself, I can't imagine how demand is just not going to continue for the foreseeable future. And that's what keeps us so optimistic, right? Even with the interest rate rises, even with all the challenges of the economy potentially slowing down, the demand is there for the housing. And we feel like both on the investor side and the owner-occ side, it's going to continue.
Yeah, so this episode is pre-recorded. And, this year I talked to a lot of investor established and new behind, not on the microphone, public information, of course. And it seems like many people this year had a really challenging year. Are you experiencing something similar, with the investor you encounter? Because what you said is optimistic, but we got to get over this year, end of 2024.
We feel very fortunate to have one of the best years we've ever had in the history of the company. We like to think it's because of the hard work that the men and women of RCN Capital do every day to make sure that investors are provided with a certainty of close and a certainty of capital. We're a big wholesale lender, so we have a tremendous number of correspondent partners out there. For those that don't know what wholesale means, it means we have smaller lenders around the country that will access our capital to deploy into communities. We take that business very seriously. And we think that because of all those things, it's gotten us to one of the best years we've ever had in the company. And we weren't sure of that going into this year, especially with all the recession talk. a lot of negativity, but it does go back to this housing shortage. The housing shortage doesn't guarantee that a lender's going to have a good year. We just feel like the hard work that we've put in has gotten us there, and our belief in our team and investing in our team through education and partnerships and really a future that's going to be bright going forward.
What other trend should investors be keeping an eye on over the next few years beside the shortage of, housing?
Oftentimes, especially more respected and regional and sort of folks that have been around for a while in the investment game, some of the things that they rely on in their investment theory is 100% employment trends. So many investors spend time thinking about where are the jobs going? And if you follow the jobs with your investment plan of attack, generally you will be rewarded with good returns. And we've seen this over and over again in the United States. The areas, and they're all the usual suspects, the Texas, the Carolina, to some respect, Florida, Arizona. There's other areas, Ohio, believe it or not, a lot of investment. These areas that are growing jobs above the national mean, investors are following those jobs with investment solutions. If I was a full-time investor, that's where I'd be going. I would follow the jobs, V.
That's amazing. That's really good advice, actually, Jeff.
Yeah, it's just, if you think about it, and it's not just big corporations relocating to other areas, but even all the support jobs that are often created by these, everybody's got to need somewhere to live. And typically these jobs that are being created in existing communities, there's just not enough housing. And investors are playing a pivotal role finding those solutions for the folks moving into those areas.
There's a lot of negative articles about investors, but I feel like I truly believe we actually do more goods than harm to the community, because of what we do.
Yeah, if you think back to how we started RCN, it was taking houses that no one even wanted on their street, literally. Like, families were living around these houses, and they were like, if we could just get rid of this house that's abandoned and an eyesore, right? The capital wasn't coming from the banks that were, oh, by the way, short selling and foreclosure. They were coming from the private sector to fix these homes up, right? And then providing a place for families to live. That private capital that's going in to finding solutions for housing, it's capitalism at its best. I think you said it best, Pete.
Well, 100%. Thank you. Now, if you have a magic wand, and you can wave your magic wand and make our real estate investing community better, what would that be?
Well, transparency is always the most important thing, right? I don't care what side of the transaction you're on, whether you're the investor buying the property, whether you're the real estate agent, whether you're the lender or the attorney or the title company. Everyone needs to think about the longevity of what they're doing and not just the transaction of the day, right? So whoever is in this transaction, and we think about it all the time as a lender, right? We don't always have good news. We have to say no. Like nobody likes to hear no, V. Nobody ever likes to hear no.
It's crazy. I was having this conversation with somebody. I said saying no is actually harder than saying yes.
It's true. But that transparency of whether it be a no or making sure that you are being completely transparent in fees and leverages, and especially with some of the ancillary fees that get added on from a title company, like everybody just needs to be upfront and fully disclose what's going on, days to close, when you can close. Like all these things are so important. If I can wave that magic wand, full transparency, because like we take it seriously. And we know that we lose business to others that aren't as transparent. And I would like to make that go away.
That's amazing. Okay. So what advice would you give your 18-year-old Jeff?
Well, it's funny. When I was growing up, I always kind of thought as an entrepreneur. But the one thing I probably never thought if I could receive that advice again, I would change my thinking into thinking bigger. Like, I don't think I ever thought big enough. Even when I started RCN Capital, I don't think which is almost 15 years ago now, like, I don't think my mindset was ever where it needed to be to think big. It wasn't until I started getting into some like real estate masterminds where I was around other people that thought big and thought about scale that my mindset transformed. I always thought about the importance of scale because I wanted to provide careers for the employees. That was always with me. But I never really thought, wow, if you could just focus on not the 1 year, but the 5 year, you could really do something special. And I think that's hard to do when you're younger, right? Because you're always thinking about, 6 months, 1 year, if I can just do this, I can do this. Whereas if you think a little bit bigger, oftentimes the reward can be much more meaningful.
See, I knew that you would deliver today. Like, I listened to all your interview on other podcasts. I do have to tell you, this is the good one.
Thank you, Fanny. You are too kind. You are too kind.
Well, finally, how does the audience get in touch with you?
Sure. So the easiest way is just go to info@rcncapital.com. Or if you're thinking about products, or do not email me directly for loans or products because I'm way too busy. But if you want to ask me about business, thoughts about building your business, I will be happy to take that. You can just send it to J Tesch, that's J as in Jeff, TESCH @rcncapital.com. I'd be happy to get back to you in an email and answer any of your questions directly. So info@rcncapital.com for loans, products, or if you want to sign up as a broker or correspondent lender, if you want to talk to me directly, jtesch@rcncapital.com.
Thank you for tuning in to this insightful conversation with Jeff Tesch, CEO of RCN Capital. We hope you now have a deeper understanding of how to find the right capital partners and secure financing to grow your real estate portfolio. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you'll never miss another expert insight. Have questions or thoughts? Drop them in the comment below. We love to hear from you. So stay tuned and see you in the next video.